right, let's talk a little bit about the markets this morning. We did see the markets set new highs once again yesterday. Our next guest says that they could head even higher from here, but there are fundamental risks. Joining us right now with more on this is Joe Zidle. He's investment strategist at Blackstone. And Joe, is the emphasis on we could head higher or there are fundamental risks? Which one comes out on top?
I think the fundamental risks right now are coming out on top. It's something that Alex just mentioned a second ago, right? It is fundamentals. They are evergreen. And 2019 has been a year that's been dominated by interest rate cuts, liquidity, central bank activity. And as a result, investors have bid up risk assets, not only equities, but all sorts of risk assets, without paying much attention to the fundamentals. And if you just step back and look at the fundamentals of U.S. equity markets, you're looking at profits growth, which is negative on a year-over-year basis. Profit margins have rolled over, and revenue growth is basically slowed to a crawl.
Let me counter those points just to play devil's advocate on this. We have seen earnings slow. We had seen all these things happen, but we kind of knew this was coming, and that's why you saw the markets go down so significantly in the final quarter of last year, with the lows being set on December 24th. A lot of what we've seen is just win back some of those losses.
Right.
We knew this was coming.
And you always have this tug of war between profits and interest rates, right? Between the fundamentals and the liquidity, if you will. And what I would say to that is we're up 23% this year, and the conversation has been, number one, about central bank easing. And you think about the reason why central bank's been cutting, because recession risks have been moving higher. So to have equities really rallying in the face of, kind of that increased recession risk, I think is a little bit at odds.
You've been way too bearish. You know that.
I've turned way too...
You've been way too bearish for the last 3 months.
And I hate to come onto the set and be bearish, especially on a morning when Alex is here.
Don't hate to do it.
My kids gave me.
Don't worry about us. We're not. Don't worry about us. We're not the ones wrong. Yeah. It's your career.
We stubbornly stuck with our 28.75 price target on the S&P 500.
28.75?
Yeah.
You're sticking with it now.
That is.
When do you throw in the towel and say, "Oops"? I mean, people won't remember.
Maybe about 30 seconds ago, Joe. So. Where we are is we're looking at these fundamentals, and I think the prices have gotten ahead of it,
Maybe.
And you have central bank activity. It's just dominating the conversation. And Becky, your point about all this stuff being priced in, you're right. Maybe some of it was priced in the fourth quarter last year where we went from plus 12% to negative 10%. But it's not as if these clouds are parting now, right? Third quarter earnings are really not very good. Fourth quarter earnings are not going to be much better. And when you talk about 2020, there are cracks out there that suggest that the environment is not going to be improving all that much.
Let me bring up something we mentioned in the last hour, and that's just the idea that there is no alternative. If you leave your money in cash, you're getting nothing back on it. The Fed continues to cut interest rates. If you put it overseas, you can put it in a bond that will cost you money over 10, 20, 30 years. Hard to find other places for where you put that cash.
That argument, though, in a late cycle environment where we know at some point growth will slow and the risks are rising, that argument gets you in trouble because it's basically like the same thing as saying, well, when the music's playing, you got to dance. And we know how that ended. So when you're putting money into investments because you're saying there's simply no alternative, take one of the more extreme examples, and that's the Austrian 100-year government bond. Right? It's in rates, in Europe, rates are negative. This government bond issued by the country of Austria at its peak this year was up 75% year to date, right? And this is not a non-meat burger alternative company. This is a bond issued by the government of Austria. So if you're buying this when it's at plus 70% year to date or 75% year to date, how is that really going to end?
Who's collecting on that bond?
I don't know how you come out of that okay.
You made a conscious decision to go bearish. When was it? About
late
7,
August.
8 months? When was it? August?
Late August.
Because I remember you
August,
had been on many times, and going all the way back to your days at Rich's company and Merrill's.
And Rich,
right. And you got bearish in August, and it's stayed steadfastly bearish since August.
And what changed for me in August was late August, early September. You had the inversions of not just the yield curve here in the United States, but you had about 10 yield curves around the world inverted. It was the highest number of yield curves that we'd seen since 2009.
So you still think that there is a recession, better than average risk of recession on the horizon in the next 12 to 18 months?
Once the main part of the yield curve inverts in the United States, the 10-year to 2-year Treasury, the data tells you have on average 20 months before your next recession.
Well, you must believe that there's a head fake in the recovery we're seeing globally in some of these other markets that were weak, because we are seeing some signs that maybe Europe's recovering a little and maybe China's coming back. So you seem to be.
If you look at how
headwinds to your thesis.
If you look at the data. and you look at the last 5 recessions that we've had, so the last, going back to the last 5 inversions of the yield curve, and if you look at the day the yield curve inverts in May of 06, in April 1998, 1988, et cetera, if you look at the point at which the curve inverts, what you find is the data actually will normally improve before the recession. So if you look at initial jobless claims, industrial production,
when will you know?
Confidence.
When will you know?
When unemployment turns higher.
No, when will you know if you're wrong, that it's not going to happen?
Well, historically, the data is going to continue to improve until you start seeing the turn in.
I mean, we know we'll have one in our lifetime.
Yeah.
But I mean, when will you decide that you were early?
The average is 20 months. I think the question we have to ask ourselves is, does it happen before 20 months or after? The longest lag in the inversion of the yield curve was 34 months. I would say that was a very early call. The shortest warning period was 13.